All right, let's dive into Helen of Troy's recent earnings report. Now, this one's a real head-scratcher. On the surface, it looked like they knocked it out of the park. They beat expectations. But then, the stock just cratered. So we're going to dig in and figure out exactly why.
So here's the central puzzle right here. You've got the good news, a beat on adjusted earnings per share and a beat on revenue. Normally, you'd expect a nice little pop in the stock, right? But instead, we got the bad news. The stock tumbled 6%, and the company slashed its guidance. This tells you right away that those headline numbers are not the whole story. The real action is in the fine print.
Okay, so let's start with the good stuff. Adjusted earnings per share, or EPS, came in at $1.71. This was just a little bit ahead of what Wall Street was expecting, so a solid beat for the quarter. Check one for the good guys.
And the top line, their revenue, also looked pretty strong. Net sales hit $512.8 million, which was well above the consensus estimate of around $505 million. So with both earnings and revenue beating expectations, you have to ask,
What gives? What's going on here? If the quarter was actually better than feared, why were investors hitting the sell button so hard? Well, the answer lies just beneath the surface, in the quality of those earnings, and crucially, in what the company said is coming next.
and this is absolutely key. We have to talk about the difference between adjusted earnings and the official GAAP earnings. While that adjusted number looked good, the company actually reported a massive GAAP loss of $3.65 per share. Now, why the huge difference? It was driven by a $65.9 million non-cash impairment charge. That's basically an accounting term for saying, hey, some of our assets aren't worth what we thought they were. And for investors, that is a major, major red flag.
Peeling back the onion on that revenue number reveals another pretty worrying trend. See, the recent acquisition of a company called Olive & June gave them a nice 7.1% boost to sales. But that boost was basically papering over some serious cracks. The core organic business, the stuff they already had, actually shrank by almost 11%. Without that acquisition, the top-line number would have looked a whole lot worse.
And this weakness wasn't isolated to just one little corner of the company. It was pretty much broad-based. Their huge home and outdoor segment, which has those amazing brands like OXO and Hydro Flask, saw sales drop almost 7%. And even the beauty and wellness segment was down a bit, and that's with the help from that acquisition. So this isn't just one problem area, it's a portfolio-wide issue they're facing.
So, faced with all these challenges, the new CEO is making some big changes. Let's take a look at management's game plan, because it signals a major, major pivot away from the old playbook and towards a brand new strategy for growth.
The CEO, Scott Uzzell, was really clear about setting expectations. And this quote, it says it all. He's essentially telling the market, look, this is not a quick fix. There are going to be bumps in the road, so you need to be patient. This is a multi-quarter, maybe even a multi-year turnaround project.
And here's the core of that new strategy. For the past few years, the company's focus was all about cutting costs. Now, it's a complete 180. The new plan is to invest heavily in marketing and innovation to try and breathe new life into these brands. They're shifting from playing defense to playing offense. But that comes with a cost. It means lower profit margins in the short term, and that is something Wall Street almost never likes to hear.
Another big operational focus is tackling the whole China tariff problem head-on. Management's got this multi-pronged plan to diversify their supply chain away from China, cut costs wherever they can, and then pass on the rest of the pain through price hikes. The big goal here is to seriously reduce their exposure to these tariffs by the end of fiscal 2026, which would really de-risk the business for the long haul.
And here it is, the single biggest reason for the stock's massive plunge. The guidance. Before the call, Wall Street was modeling over $4 in adjusted earnings for the full year. But management came out and guided to a range of $3.25 to $3.75. That's not a trim, folks. That is a slash. It's a huge cut that signals the costs of this new investment plan and the soft market are going to hit profits way harder than anyone was expecting.
So, let's put it all together. The weak organic sales, that massive write-down, and the absolutely brutal guidance cut. What's the final takeaway? What is the market's verdict, and what could it mean for the stock going forward?
To really put this in perspective, just look at the stock's performance over the past year. While the broader market, the S&P 500, was up almost 17%, Helen of Troy just got decimated, down over 66%. This is not a stock that has the market's trust, and this latest report, well, it did absolutely nothing to help that.
Given this entire backdrop, our rating on Helen of Troy is market perform. Now, this isn't a call to run out and buy the stock, but it's not a call to sell it either. It just reflects that this is a company in a really deep transition with a very, very high degree of uncertainty.
And here's the thinking behind that rating. The bull case, it's pretty clear, right? You have a new CEO with a plan to grow, a portfolio with some genuinely great brands like Osprey and Exo, and a stock that's trading at a pretty depressed valuation. The bear case, though, is just as powerful. This turnaround has immense execution risk. The consumer is feeling squeezed, we don't know if they can actually raise prices, and the stock's momentum is just relentlessly negative. It is a classic battle between potential value and some very significant risk.
Okay, now for our final segment. Given this high-stakes, high-uncertainty setup, how might a hedge fund analyst try and pitch a trade on a name like this?
The trade idea here is what's called a long-dated strangle. Now, this is an option strategy, and what's fascinating is that the options market itself was implying a huge 17.5% move around this earnings event. That tells you that even the pros are expecting massive volatility ahead.
So here's the logic. You buy both an out-of-the-money call option and an out-of-the-money put option, with expirations about 6 to 9 months from now. The whole thesis isn't about whether the stock goes up or down. It's a bet that it won't stay flat. The idea is either the new CEO's turnaround plan starts to work and the stock rallies hard, or it fails and the stock continues to slide. This trade makes money from a big move in either direction because you're betting against the one outcome that seems least likely, that the company just kind of muddles through.
And that really leaves us with the ultimate question for Helen of Troy. With a stock that's been beaten down this badly and a brand new plan in place, are we looking at a deep value opportunity, a coiled spring just ready to bounce back? Or is this a classic value trap, a business whose problems are just too deep to fix? The next few quarters are going to tell us everything.
This is not financial advice.